Hi, I am Anna. I come from www.ntvforex.com. What will US Fed decide? Analysis. http ntvforex.com News ID 817E2D911 2020 11:28:18 a.m. Next week, the Fed's FOMC will convene. Now that the reinterpretation of the mandate monetary policy review has been completed week ahead of August 28, 2020, the FOMC can turn its attention to other, more concrete issues. Although further easing of monetary policy was discussed at the last meeting at the end of July, the environment has improved since then. New COVID-19 infections have fallen again and short-term economic indicators have improved, so that overall strong economic growth can be expected for the third quarter. We therefore do not expect any easing of monetary policy next week. However, some things will change in the coming months. Various speeches by Fed representatives have already pointed out that monetary policy will shift from stabilization of the markets to support of the economic recovery. What this means in concrete terms is not entirely clear. At its core, it will probably be about giving the markets a longer-term outlook and thus more planning security. Measures have been under discussion within the FOMC for some time now, with two of them expected to be implemented this year. The next interest rate hike, however far away it may be, should be linked to the achievement of certain inflation and/or unemployment rates. According to the results of the monetary policy review, only the former actually seems possible. It is conceivable that a commitment will be made to raise interest rates again only once the inflation rate has reached the target of 2%. This would be consistent with a temporary moderate overshooting of the inflation rate above the 2% target and therefore with the outcome of the monetary policy review. The second measure could be to tell the markets for how long and to what extent securities purchases should continue. Currently, the Fed is buying on an open-ended basis, as needed. Whether these measures will be announced next week is an open question. However, the upcoming presidential election would argue in favor of that. The next meeting of the FOMC after September is scheduled for November 4-5, immediately after the presidential election on November 3. What the environment will be like then is not known. It could be unfavorable for additional news. But it is also realistic to wait until the last meeting of the FOMC on December 15, 16, because there is no reason to rush. The market reaction to the linking of the first interest rate hike to the achievement of a certain inflation rate and a more precise specification of the securities purchases will depend on the concrete design. The most likely scenario for us is that this will not change much for the markets. The timing of the first interest rate increase is so uncertain that a link to an inflation value should not trigger a market reaction. The same also applies to a more precise design of future purchases of securities. The markets will rightly assume that the Fed will in any case provide enough liquidity for the foreseeable future to keep bond yields low. Next week, new expectations from FOMC members for the development of key macro variables will also be released. These forecasts have lost some of their significance, as opinions within the body regarding interest rate developments are homogeneous. In the June survey, only 2 out of 17 respondents expected an interest rate hike by the end of 2022. But the numbers could nonetheless contain some slight excitement. Firstly, regarding whether the outcome of the monetary policy review will have any impact on the forecasts, and secondly, because expectations for 2023 will be released for the first time. Easy. How strongly is the industry recovering in July? With data on industrial production for July, Eurostat will provide an important indication next week, September 14, for the assessment of the momentum of the economic recovery in the Eurozone. Sentiment indicators point to a further increase in output in July. Already this week, data for Germany and France showed that the recovery continued in July. However, as expected, the pace of the recovery has slowed down compared to June. Nevertheless, due to the sharp fall in industrial production in April and May, output volume in July was still 13% higher than the 2Q average in Germany and 19% higher in France. We therefore believe that the Eurozone economy is on track for a substantial recovery in 3Q compared to 2 quetzales. Download the full week ahead. Subscribe our channel to receive the news as soon as possible.
Thank you for watching. If you want to read real-time news, text messages to MT5 Expert Advisors page at https://m.me/mt5.expert.advisors.